There is a pattern that repeats itself often enough to be worth examining. A highly capable professional, someone who has spent years building genuine expertise, navigating complexity, solving problems that most people cannot, begins investing seriously, and within a few years, sometimes less, they have made a series of decisions that quietly erode a significant portion of what they built. It is not a matter of information. These are not people who lacked access to data or analysis. It is not laziness. They applied to markets the same intensity that made them successful everywhere else. And yet the outcomes were poor. This is the paradox that behavioral finance keeps returning to. Intelligence, in almost every domain we study, is a reliable predictor of performance. It predicts academic achievement, professional advancement, problem-solving ability, income. The correlation is not perfect, but it is consistent and well documented. So why does it appear to break down in financial markets? The uncomfortable answer, and it is one worth sitting with, is that financial failure among intelligent people is rarely an intelligence problem. It is a behavioral problem, and the higher the intelligence, the more sophisticated the behavioral error tends to become. Before going further, it is worth drawing a distinction that psychology has been careful about for decades, but that most financial conversations collapse entirely. Intelligence and rationality are not the same thing. Intelligence, in the technical sense, refers to analytical capacity, the ability to process information quickly, identify patterns, construct logical frameworks, hold complexity in mind. It is a genuine cognitive advantage. In most environments, it translates directly into better outcomes. Rationality is something different. Rationality is decision quality under uncertainty. It is the ability to form accurate beliefs about the world, update those beliefs when evidence changes, and act in ways that are genuinely aligned with your own long-term interests, even when doing so is uncomfortable. The distinction matters because most careers are fundamentally deterministic. If you are a skilled surgeon, a rigorous engineer, a talented analyst, the relationship between effort, intelligence, and outcome is relatively tight. Apply more rigor, produce better work. The feedback loop is reasonably clean. Markets do not work this way. Markets are probabilistic and adaptive. They aggregate the behavior of millions of participants, each responding to the same information in different ways for different reasons on different time horizons. The relationship between the quality of your analysis and the quality of your outcome is loose, noisy, and often delayed. You can reason well and lose money. You can reason poorly and make money, at least in the short term. Intelligence builds models. It does not eliminate randomness. And environments where randomness is high require a different kind of mental discipline than environments where skill compounds cleanly. Here is where it becomes psychologically interesting. Intelligent people are, by definition, people whose internal reasoning has served them well. They have a long track record of being correct. Their models of the world have proven reliable. Their confidence in their own judgment has been repeatedly reinforced by outcomes. This is not arrogance. It is evidence-based self-trust, and in most contexts, it is appropriate. But markets have a way of exploiting that self-trust. The smarter you are, the more persuasive your own reasoning becomes. When an intelligent investor constructs a thesis about a company, a sector, a macro trend, the thesis is usually coherent. It draws on real information. It follows logically. It feels different from speculation because it is supported by analysis. What it does not account for is that a coherent thesis and a correct thesis are not the same thing. The practical consequences of this are specific and observable. Intelligent investors tend to take larger position sizes because their conviction is higher. They tend to update their beliefs more slowly when contradicting evidence arrives, because the original analysis was thorough and the new information can always be explained away. And they tend to develop an emotional attachment to their forecasts that makes reversing course feel like an intellectual defeat rather than a rational adjustment. The result is a particular kind of stubbornness that is almost invisible from the inside. It does not feel like stubbornness. It feels like discipline. It feels like not being shaken by short-term noise. The distinction between principled conviction and motivated reasoning is genuinely difficult to see when you are inside it. There is a related phenomenon that compounds this. Human beings are narrative creatures. We do not naturally think in probabilities. We think in stories, sequences of cause and effect that feel meaningful and coherent. And intelligent people are, almost by definition, skilled at constructing those narratives. When markets move, there is always an explanation available. When a stock declines, the intelligent investor can usually construct a compelling account of why the market is wrong, why the thesis remains intact, why patience is warranted. The explanation feels rigorous because it draws on real analysis, but the quality of an explanation and its predictive accuracy are almost entirely separate things. This is particularly dangerous in hindsight. After a market event, the sequence of causes appears obvious. The signs were there. The logic was clear. This retrospective clarity creates a powerful illusion. The illusion that financial outcomes are more predictable than they actually are, and that better analysis would have produced better foresight. It rarely would have. Markets are complex adaptive systems. The factors that move them include variables that no individual analyst can fully observe or model. Accepting this is not pessimism. It is a prerequisite for clear thinking. Probabilistic reasoning, holding multiple outcomes in mind simultaneously, assigning weights rather than certainties, updating continuously, is not natural. It requires practice and, more importantly, the willingness to resist the pull of a satisfying narrative. That resistance is harder for people who are genuinely skilled at building those narratives. For high achievers, there is a layer beneath all of this that is worth naming directly. In most careers, being right matters. More than that, being right is identity. Competence becomes self-worth in ways that are difficult to fully separate. The professional who is consistently correct, consistently sharp, consistently ahead of the room, builds an identity around that accuracy. Investing, done honestly, requires dismantling parts of that identity. It requires admitting error quickly and without drama. It requires updating beliefs under pressure, when the ego most wants to hold firm. It requires detaching the outcome of a particular decision from any assessment of your own intelligence or worth. These are not things that high achievers are typically trained to do, because in most of their previous environments, they were not necessary. This is why intelligent investors hold losing positions far longer than they should. The act of selling at a loss is not just a financial decision. It is an acknowledgement that the original thesis was wrong. And for someone whose identity is built around the quality of their thinking, that acknowledgement carries a psychological cost that the financial calculation alone does not capture. Flexibility and pride are in tension here. And in markets, the cost of that tension is measured in returns. There is one more pattern worth examining, because it runs counter to what most intelligent people expect about themselves. In professional environments, action is productive. Progress is the result of effort, optimization, improvement. The intelligent professional is always looking for a better way, a more efficient process, a sharper analysis, a more refined approach. This orientation is enormously valuable in most contexts. In investing, it often destroys value. Research on trading behavior consistently shows that higher activity is associated with lower returns, particularly among investors who are confident in their analysis. The search for optimization, the feeling that something can always be improved, that a better position is available, that the current allocation is not quite right, generates friction, taxes, and decisions made under the illusion of control rather than genuine edge. Markets often reward endurance more than refinement. The investor who holds a sound position through volatility without interference frequently outperforms the investor who is constantly improving their approach. This is deeply counterintuitive to people whose entire professional identity is built around active problem solving. Intelligence seeks improvement. Wealth, more often than most intelligent people find comfortable, requires simply waiting. Which brings us to what the actual edge in investing looks like. It is not a higher IQ. It is not faster analysis or more sophisticated models or access to better information. The people who have competed on those dimensions against institutional capital have largely found that the edge is smaller than expected, more difficult to sustain, and more dependent on luck than the analysis suggested. The durable edge, the one that compounds quietly over long periods, is behavioral. It is the ability to hold a position through drawdowns without losing the original reasoning. It is the willingness to sit in cash when there is nothing compelling to do, resisting the pressure to be active. It is the capacity to update beliefs quickly when evidence changes, without ego involvement in the previous position. It is patience that is not passive, but deliberate, the product of clarity about what you own and why, and genuine indifference to short-term noise. These are not intellectual capacities in the conventional sense. They are closer to emotional regulation, and they are trainable, but only by people who recognize they need training, which requires a kind of intellectual humility that is genuinely difficult for people who have spent years being the most capable person in most rooms they enter. Discipline compounds. Brilliance fluctuates. So we return to where we began. Intelligence is one of the most valuable assets a person can possess. It opens doors, solves problems, builds things of genuine worth. None of what has been said here is an argument against rigorous thinking. But markets are not a test of intelligence. They are a test of behavior under uncertainty over time. An unmanaged intelligence, intelligence that has not been examined for its own biases, its own attachment to narrative, its own need for control, does not protect against poor financial decisions. In many cases, it amplifies them. The market does not reward the smartest person in the room. It rewards the most behaviorally stable. That distinction is quiet. It is not exciting. It does not make for compelling dinner conversation. But it is the one that, compounded over decades, tends to matter most.